Welcome back to the Deep Dive. We're here to cut through the noise of corporate earnings calls and give you the insights you really need.
Yep, and today we're tackling the investment banking world, specifically Perella Weinberg Partners, PWP, their Q3 2025 call.
Right, and this call, it really set up a fascinating clash, didn't it? You've got this big, bold, long-term strategy talk from management.
Crashing right in some pretty harsh quarterly numbers, a real narrative battle.
Exactly. Long-term vision versus short-term pain. And, well, the market reacted mostly to the pain, let's be honest.
So let's get straight to those headline figures, the ones that move the stock.
Okay, the results snapshot.
So the bottom line first. Profitability was a bit soft. Non-GAAP adjusted EPS, it landed at $0.13.
13 cents. And the street was looking for what, 14, 15 cents?
Yeah, consensus was more like $0.14 to 15 cents. So a miss, definitely a profitability shortfall, though maybe not catastrophic on its own.
But that wasn't the real shocker, was it?
No.
Yeah.
The top line revenue figure, that's what really grabbed attention.
Grabbed attention in a bad way. Looked more like it took a dive.
It absolutely dove. Revenue came in at $165 million. Now remember, the consensus range was comfortably $180 million up to maybe $202 million.
So they missed the low end by $15 million. That's significant.
Very significant. And year over year, that $165 million, it's down about 41%.
41%. Wow. Okay. When you see a number like that from a boutique bank, people immediately start asking questions. Strategy kind of goes out the window for a second.
Exactly. The market reaction was swift and negative. That revenue miss just dominated the narrative on the day. It felt like investors were saying, forget the future plans for a minute. What about now?
Right. Show me the money, basically.
Which leads us nicely into digging deeper into those financials. Why was the EPS under pressure, even if, maybe the miss wasn't huge? It comes down to costs.
Specifically, the compensation ratio.
You got it. The adjusted compensation ratio stayed really high, up at 67% of revenues.
67%. Okay, normally you'd expect that closer to, what, 55, maybe 60% for an advisory firm?
That's the typical range, yeah. So paying out 2/3 of your revenue, especially when that revenue base just shrank significantly.
It tells a story. What story is that 67% telling us?
It tells us management made a very conscious and probably quite painful choice. They decided to keep investing, actually growing their senior banker headcount right through this M&A slowdown.
So they're paying people these expensive new hires, their guarantees, their fixed costs.
Before those bankers are actually bringing in deals and generating revenue to cover those costs. It's the definition of investing through the cycle. Heavy investment when the market isn't cooperating.
That's the financial sting of this strategic pivot they're making. Now, what about other costs? Did they show discipline anywhere else? Try to reassure people?
They did try. Adjusted non-compensation expenses were kept pretty tight at $37 million, roughly flat compared to the previous quarter.
Okay.
And they specifically guided for only a low single-digit increase in those non-comp costs for the whole year, 2025.
So the message is, the only spending surge is on people, on the talent investment.
Precisely. That's where the quote-unquote bloat is, if you want to call it that. It's strategic spending on capacity.
But can they afford it? Can they sustain this kind of investment with a 67% comp ratio on lower revenues? What's the balance sheet look like?
That's their safety net. The balance sheet is, frankly, pristine. They ended Q3 with $186 million in cash.
And debt.
Zero debt. None. So that strong liquidity position gives them the breathing room, the confidence to make these long-term bets without, existential fear.
And they're still returning capital too.
Oh, yeah. Over $157 million back to shareholders year to date. That's through dividends, share settlements, buybacks, retiring over 6 million share equivalents.
But hang on, the Q3 buyback activity was pretty limited.
It was, and that's telling. It suggests they were consciously funneling capital away from repurchases and towards these strategic investments like the acquisition we'll get to.
Right. It shows real conviction in their strategy, or maybe, hubris, depending on how it plays out.
It's definitely a bold signal.
Yeah.
And what are they betting on? Two really big things. First, this massive hiring spree.
The senior banker blitz, as they called it.
Yeah, biggest investment in people in the firm's history. They added 25 senior bankers just this year so far.
25. Let's put that in context. These are senior people, partners. That's like 18% of their entire partner base added in less than a year.
It's huge. Nearly a fifth of the senior ranks. Brought in very quickly. The integration challenge alone must be significant.
Absolutely. So when do these folks actually start paying their way? What's the timeline for them contributing meaningfully?
And that's the crucial point and why Q4 might still feel the pressure. Management was clear. Out of the 25, 9 are internal promotions, already ramping up.
Okay.
But the other 16 are external hires. They're the really expensive group, the big investment. And they're expected to start contributing meaningfully in 2026, not really this year, 2025.
So there's the mismatch. The cost hit the books now in 2025.
Exactly. But the revenue payoff is deferred, maybe 12, maybe 18 months out. That's the source of the current financial squeeze.
Got it. Okay. And the second big move, the acquisition.
Right, Devon Park. That deal closed October 1st. It brought in a 15-person team.
And what do? What's their specialty?
Private funds advisory. Specifically, they're experts in GP-led secondaries and continuation funds.
Okay, GP-led secondaries. Let's unpack that for listeners. What does that actually mean, and why is it seen as maybe a hedge against the ups and downs of traditional M&A?
Right. Think about it like this. Normal M&A, buying and selling whole companies, that really relies on a strong economy, confident CEOs, liquid markets, all that.
Sure.
GP-led secondaries are a bit different. A GP, that's the general partner, the private equity firm managing the money, they want to restructure an existing investment. So instead of selling a great company they own completely, they might sell it from one of their older funds to a new fund that they also manage. It lets the original investors get some cash back, but the PE firm keeps control of the asset to grow it further.
So it's basically like internal restructuring within the private equity world itself, less dependent on finding an outside buyer immediately.
Exactly. And PWP had like zero revenue from this area last year. It's a completely new capability for them.
And the market itself is growing.
Hugely. The secondary market is expected to be over $200 billion this year. Management saw this as the perfect time to jump in. It gives them potentially nonlinear growth.
How so?
Because this new Devon Park team can immediately tap into the relationships PWP's other 75 partners already have with private equity firms, credit funds, infrastructure investors all over the world. It's supposed to create synergies, a diversification play.
Okay, so the big picture strategy is use the downturn to hire aggressively, build capacity, and buy this new capability, Devon Park, to diversify away from just relying on purely cyclical M&A deals. Makes sense on paper.
Right. But let's look at what actually drove the revenue in Q3. What deals were closing if traditional M&A was so weak?
Good question.
Well, the Q3 revenue drop was squarely because fewer traditional M&A deals closed. That was the main driver.
But something must have offset it slightly.
Yes, partially offset by a stronger contribution from restructuring and liability management advisory.
Restructuring.
Yeah.
We keep hearing whispers about, cracks appearing in credit markets. Is PWP's restructuring business picking up because things are about to get really bad systemically?
Management tried to pour some cold water on that idea. They described the liability management business as being at a very steady pace. It'll contribute more this year than last, for sure.
But not flashing red alarms.
Not according to them. They seem to view the recent bankruptcies and credit stress as more isolated situations, not, a repeat of 2008 brewing.
Okay, so let's talk about that pipeline disconnect then. Management says they have a record pipeline, record number of active deals. But Q3 closings were weak. What gives?
That's the million-dollar question, isn't it?
It's just deals getting pushed into 2026. Or is there a risk this pipeline just goes stale? Pipeline fatigue.
That's the core risk. Management is clearly betting on delayed closings. They specifically said the pipeline is now weighted back towards traditional M&A. So the potential deals are there, in theory.
But clients are hesitant to pull the trigger. Pricing, maybe? Uncertainty.
Probably all of the above. PE firms might be coming off the sidelines, exploring sales, but they're still very cautious. PWP is banking on this huge backlog building up for 2026.
A backlog that their newly expanded, very expensive team will be ready to execute.
That's the plan. But if those deals keep getting delayed or if the pipeline does go stale, then investors are going to look at that 67% comp ratio and get very impatient.
Okay, so let's zoom out. For an informed investor watching this, how do you frame PWP right now? It feels like a really high-stakes bet.
It absolutely is. It's a long-term wager wrapped up in a pretty painful quarterly report. You see the firm clearly pivoting, right? Moving from just pure play MA to something broader.
Adding those hedges like alternatives with Devon Park and the restructuring piece to smooth out the cycles.
Exactly. They're building that more resilient platform. But in the short term, the market just saw the pain. 41% revenue drop, that sticky 67% comp ratio.
And this wasn't exactly a stock flying high beforehand, was it?
No, the backdrop was already challenged. The stock had seen pretty significant negative returns over the last 3 months and the last year, so this miss just landed on already bruised sentiment.
Right. Negative news hitting a weak stock often gets amplified. So looking ahead, what are the key things, say the top 3 catalysts we need to watch? What validates their strategy and proves this pain was worth it?
Okay, number 1, definitely. Early wins from Devon Park. We need to see evidence that this private funds advisory business takes off, gets mandates, proves the synergy story, proof that nonlinear growth is real.
Makes sense. Number 2.
Number 2 has to be the conversion rate of those 25 new bankers. We need to see them actually announcing and closing deals in 2026. They need to shift from being cost centers to revenue generators. That's the biggest operational test.
The hinge point, really.
Totally. And number 3, more macro. Just a broader, sustained rebound in actual M&A closings heading into the first half of 2026. That fills the pipeline and solves the revenue problem almost instantly.
Got it. Devon Park, execution, banker productivity, and market rebound. Okay, it's time for our segment where we toss out an outrageous but plausible trade idea based on everything we've just discussed. Quick reminder to everyone listening, this is for educational discussion only. It is absolutely not financial advice.
Wait, let's frame this as a pure operating leverage play, a high-octane bet, really.
All right, lay out the thesis. Why is PWP potentially set up for such an explosive move, maybe in 2026?
The core idea is simple. PWP has already paid the price. They've absorbed the upfront costs of hiring those 25 bankers. That's why the comp ratio is sitting at that painful 67% level now.
So Q3 was kind of the low point. All the costs hit the income statement.
But almost none of the related revenue has shown up yet. The market is pricing the stock based on the cost side of that investment equation today.
Okay, so the stock reflects the pain. What's the specific trade idea? The outrageous but plausible move.
You could consider a short-term defensive hedge, maybe just limiting exposure through the end of this year, given potential ongoing M&A sluggishness in Q4.
Okay, protect the downside near term.
But simultaneously, you take a really aggressive bullish long position using call options dated for the first half of 2026.
1H 2026 calls. Why calls? Why that timing?
Because it's a pure bet on operating leverage kicking in. If, and it's an if, but if M&A closings rebound even moderately next year and those new bankers start hitting their stride, then that new top-line revenue growth falls almost straight to the bottom line. That 67% comp ratio could compress very quickly back towards their target, maybe 60% or even lower.
And because the cost base is already largely fixed at this higher level, any significant revenue beat means earnings per share, the EPS, could explode way past what analysts are currently estimating.
Exactly. The upside potential is magnified because the costs are already baked in. You're betting that this massive high-cost capacity they just built finally meets a recovering market in 2026.
A calculated gamble that the strategy finally pays off when the market turns. Very interesting.
It's betting on the pivot working, essentially.
Okay, that wraps up our deep dives into Perella Weinberg's Q3 2025 earnings call. A really clear tension here. Big strategic ambition, the hires, the Devon Park deal.
Sit against a really tough quarterly print on the revenue side, which definitely has investors feeling cautious right now.
So that leaves us with a final thought for you, the listener, to chew on.
Management made a very deliberate, expensive move into that GP-led secondaries market with Devon Park. It's a space seen as somewhat insulated from traditional M&A cycles. Now the question is, will this prove to be a brilliant, necessary hedge that adds nonlinear growth, especially if the next downturn hits? Or if traditional M&A comes roaring back next year, will Devon Park look like an expensive, maybe even unnecessary distraction? Will the only thing that really mattered have been getting those 25 core M&A bankers productive?
A fantastic question. Which path will prove more valuable? That really highlights the crossroads PWP is at. Thanks for joining us on the deep dive. Keep thinking about the implications of this strategic pivot, and we'll catch you on the next dive.